Now we come to the numbers. So we're going to be looking at the statement of profit or loss and the statement of financial position for Menteen. What I've done is I've put together a document for analysis of the financial statements. There's some ratios calculated here too, but of course the profit and loss statement and financial statement of financial position show the exact same figures as are seen in the preceding document by CIMA. So this document also shows percentage changes and things like that, so it helps us with our analysis. Okay, starting with the consolidated statement of profit or loss, we have a comparison between last year and this year. And the very first thing that jumps out, of course, is the quite significant decline in revenues, 7%. That's something definitely to be concerned about. And there is a hint a little bit later on in the pre-seen materials that fewer films are being made by Menteen due to a lack of financing. I believe that comes up in the SWOT, which we'll look at shortly. So this is a concern. If there are fewer films being made and there are fewer films being shown in the cinemas, it leads to falling revenues for Menteen. There is a decline in overall expenses, but it's not as high as the decline in revenues, and this is squeezing the operating profit, which is down very significantly, 21% decline in operating profit for the year. So again, this might indicate to me that this is a company with cost discipline, where there has been a decline in activity perhaps over the year, in that fewer films are being made. You would expect the decline in expenses to match the decline in revenues. It does not. The expenses are falling more slowly than the fall in revenues, and that is concerning. This is a company that's struggling with its costs. It seems it's referred to the fact that it finds it difficult to track costs, to budget well. We know that this is an industry with problems of delays. And that causes all sorts of issues with costs too. So it seems to be reflected in the profit or loss. We have some finance costs here, which indicate that this is a company that is indebted, that has a loan. Interestingly, the finance costs have actually come down over the year from 48 million B dollars to 40 million B dollars. Actually, what you see on the statement of financial position is that loans have increased. So it leads me to ask the question, why have the finance costs come down? Maybe they've renegotiated terms with their lender. Maybe they've renegotiated a more favorable interest rate, or perhaps the term of the loan. And then we see the net profit is also down by almost 24%. That's quite a significant drop over the year. So quite concerning really for Menteen. The numbers are going in the wrong direction. When we look at the statement of financial position, the first thing that jumps out under the non-current assets section is there's been quite a significant increase in the largest aspect of non-current assets for Menteen, investment in films. However, it's not being reflected in the revenues as we just saw. So Menteen, it seems, is investing money in perhaps buying up rights to books and other items that they may turn into movies at a future stage. But if they're having trouble attracting financing, then these ideas are not going to get turned into movies, and that means they won't be reflected in future revenues. So if they're not getting the financing, they're not attracting it, there's no way really to turn a lot of these ideas into the final product, which is movies. Property, plant and equipment, it's quite a small percentage of the total non-current assets. That might indicate that this is a company with more of an emphasis on distribution, the distribution side of their business, and perhaps they're less and less involved in production. I talked before about, the big Hollywood movie studios. They're really involved in the distribution side of the business, and often they actually outsource production to smaller production companies. So it makes sense that they might have lighter physical non-current assets like property, plant and equipment. We move to current assets. You've got the receivables figure there. It's not up significantly. So we're talking there about the receivables from customers in the form of the cinema chains, TV networks, airlines, and merchandising from restaurants and things. The bank figure, it's quite low, I would say, compared to, the investments that they make in movies. It's not going to get them a lot, really, considering some of the big investments that are needed in this industry. So total assets are up 6.5% over the year, as I said before, not yet being reflected in higher revenues. And if they don't find financing for these movies that they want to make, then they're going to have a problem with revenues down the line. There's no fresh equity being issued, no new shares being issued this year. Retained earnings is up about 35%. Okay, so they're not using up all of their net profit to pay dividends. Quite a part of that net profit is being funneled into retained earnings. Now, very interesting here, because we come to, you would expect to come to the non-current liabilities and current liabilities. But what we see here is that there is no split. And this is a company that's listed on the stock exchange and is said in the very first page of the pre-scene to be IFRS compliant, or rather following those standards. And we see here that they are not. They're not being IFRS compliant. There's no split between non-current and current liabilities, and that is contradicting the rules set out by the International Financial Reporting Standards. So there's an issue there. I would say that it could come up in the exam. Maybe you will be questioned on this, and it's a little bit maybe of an ethical issue, because if you think about the CIMA Code of Ethics, there's maybe a principle being violated here in the form of professional competence and due care. The financial statements are not being represented in the way they should be here. This makes our task of putting together certain ratios a little bit trickier, because of course if you think about a ratio like if you're thinking of the liquidity ratios, you need to examine your current assets compared to your current liabilities, and we're not exactly sure which of these four items is classed as current, which is classed as non-current. So it's a little bit tricky, and what I've done for the sake of simplicity is I have assigned 3 of these as current and 1 as non-current. The first loan figure I'm assigning as current, because we see there are some more loans further down here that there's a higher total, and the payables, they usually fall under the current liabilities section. Deferred revenue is often regarded as a current liability, so I've assigned it as a current liability for the sake of our analysis here, in order to be able to perform some ratio analysis. But it's a little bit subjective and it's not ideal. But with the ratios, what's important is to see the evolution of the ratio over time. So we'll see those in a moment. So no big increases really here. Their loans are up, as I said before, both. Let's say if it's a short-term loan, up the first one, and the third item here, the film obligations and production loans, we're maybe looking at a longer-term loan here. So loans are up. Interest payments, though, as we said, seem to be coming down. And the payables to suppliers, up very, very slightly. There doesn't seem to be an issue there. So we're talking about the acting talent, the directors, the screenwriters, etc. And the deferred revenues are up about 6%. So we're talking here about payments being received ahead of delivery of the good or service. So Menteen in such scenarios has an outstanding obligation, so they're being listed as a liability.